Good morning, good afternoon, everyone. We still have participants joining, so we'll give it just another few seconds here. Okay, good morning, good afternoon, everyone. My name is Stephanie Staska, and I will be your moderator for today's webinar. Thank you so much for joining. Looking forward to presenting today on financial trading in U.S. ISO markets. So just a few reminders, updates for the audience. Everyone is muted automatically, so you won't be able to unmute yourself. There is a Q&A feature in Zoom. We do encourage you to put questions there. You can put them throughout the presentation, and we do have dedicated time at the end of the webinar specifically to answer questions. Please don't use the chat feature to chat with the presenters. They won't be able to necessarily see that while they're presenting. So if you do have questions, please send them via the Q&A. Also, we will be recording this session and it will be shared with attendees after the fact. So if you have joined late, missed the first couple seconds of this, don't worry, you can go back and watch any of the content after the fact. And those reminders were also put in the chat by my marketing team, so you will see those throughout the event as well. Next slide, Jake. Awesome. So today we'll do a quick introduction of who our speakers are, and then we'll cover why are U.S. power markets so attractive. Obviously, you've joined this webinar, you think they're attractive, so we're going to cover some overview and basics of why these markets are so attractive to investors and participants. Also, we want to talk about how does financial trading actually work in the US ISOs, because it does differ a bit from European ISOs. And then the next question really is, how do you get started in trading in these particular markets? And then I mentioned that dedicated Q&A at the end, so we'll have that as well. Next slide, please. Awesome. So today our speakers are myself. I'm Stephanie Staska. I'm the Director of Trade and Risk Products here at Yes Energy. I'm joined by Jake Landis. He's our Director of Solutions Engineering and former power trader. And Paul Pontenagel, who's the Managing Director of Time2Market. So first, we're going to get started with why are U.S. power markets so attractive? And I'm going to hand it over to Jake.
Thanks, Stephanie. And as Stephanie mentioned, before joining Yes Energy, I was on the other side of the camera, worked at a large regional utility, and then at a spec trading shop trading a lot of the financial products that we're going to talk about today. So first few slides here, I just want to talk a little bit about the US power markets, how they're structured, and again, kind of some of those reasons why they're attractive for financial trading. The image on the right, all of the shaded areas are the different ISOs or RTOs that comprise the markets we're really going to be talking about today. So there's 7 of them across the US. It handles about 60%, 66% of the entire US electric load. And when we think about what ISOs are, you know, in the traditional makeup of the power grid, when it started, we had regional utilities that had their own generation. They served their own load areas, and that was it. They all kind of operated in these silos, taking care of their own service territory. The shaded areas constituting the ISOs and RTOs, we left that model and moved to a kind of centralized control in those different regions. So there's a singular entity utilizing all the different generation assets and transmission across those different areas to dispatch all of the plants and serve the total load of that area. One of the unique ways that they do that is through what we call nodal power markets. And so the image on the right constitutes all of the different nodal price locations in the 7 ISOs that we're talking about today. One little quick note, you'll notice in the western part of the US, there is a big blank spot right now. There are power markets in those areas. They just don't currently have financial trading. There is, in the next 18 months or so, plans to expand those markets, and some of them will also have financial trading opportunities. But the good part about this, and the map that we're looking at here, and why there's a lot of attractiveness to trading financially in the US power markets, is all of the dots, circles, squares, stars you see on that screen constitute things like generators, loads, different power hubs, zones, interfaces. It totals about 12,500 nodes across the US. And the really nice thing there is that each one of those nodes is effectively tradable through a financial product. Each node has its unique price. Again, those prices are being set by those individual ISOs, that centralized dispatch model. But again, there's 12,500 nodes of opportunity for financial trading. One of the other things that makes it even more unique and you have more opportunities to trade is that each one of those nodes you can trade every hour of the day. So I have a quick chart on the right-hand side there. Hours 1 through 24, I have the day ahead and the real-time price in the yellow and green. And then the spread, the difference between the day ahead and real-time price, which is effectively what we're trading, where the opportunity is. Again, you can have a trade for any or all hours of the day. You can also go long or short any hours in those days. So when we really start to think about the possibilities of all of the different trades that you can put on, multiply that across the 12,500 nodes, and there's a lot of opportunity there. One of the other nice things about the different ISOs around the country is that they're all relatively unique. They all have their own kind of ways of operating, their own makeup, and their different opportunities in each market. The map view that I have there on the left-hand side, I've actually superimposed all of the different generating assets across the US. And I know the image is a little hard to see, but the different shapes there are indicating the different fuel types that are possible. So we have coal plants, nuke plants, gas plants, your wind, your solar, your hydro, and each region of the country kind of has its own unique makeup, which also creates different ways that price formation happens in those different regions. So not only do you have the geographic spread across all of the ISOs, but you also have unique characteristics of each market. The chart over there on the right-hand side is just a representative. I grabbed, I think, 5 different of the ISO's actual demand shapes, and that's going to be actual demand, not net demand. We also have data on that. But what you'll also notice, even within the demand curves, is that there's differing shapes. There's obviously different magnitudes, and Stephanie will talk about that a little more later. All of the ISOs are different size. That's also going to affect the amount of activity in each ISO. The other great thing is that not only do we have all of these varying different market dynamics across the different regions, we have geographic spread, we have the different makeup of the ISOs. Using those nodal prices to dispatch and control the power grid here, you can even have localized opportunity for arbitrage. In this case, I grabbed a quick snapshot looking at SPP, and I'm really kind of just looking around the greater Oklahoma City area. To the north there, you can see that prices during this time segment were negative $52. And on the other side of the transmission constraint, and we won't get into that too much, but transmission constraints are congestion on the grid that causes a differential in pricing across a different piece of transmission equipment that's in danger of being overloaded. And on the south side here, so we went from a minus $52 price point to the north to a positive $254 price point on the south. So again, kind of all the opportunities that you have to trade, all the different regions, even on the really local scale, there's also opportunities for arbitrage. I'm going to hand it over to Paul here for a minute and talk a little bit about the differences between that kind of nodal system and the ISOs of the US markets and then some of the EU markets. So take it away, Paul.
Thank you very much, Jake, and thank you everyone for being here and listening to our webinar. We have some audience from the US, definitely also some people from Europe, and of course, worldwide some audience, but we want to emphasize here the differences between the markets, as Jake already said. On the left-hand side, US power markets focusing on financial ISO trading today, and on the right side, the European power markets, which are very different in its nature. The financial trading on the ISOs is, as the name suggests, it's virtual, it's financial, you don't have the physical effect as such. And there is already a huge difference compared to the European power markets, which are shown on the right side here. European power markets are basically divided in country areas where some countries have different price zones, but typically there is about one TSO per market. You need to be set up as a BRP in a specific country. You have over 25 countries participating in the market coupling, and all this is happening physical. The day-ahead market and the intraday market are both physical markets, and you need to have a physical setup in place to speculate on day-ahead to intraday spreads or volatility on the intraday markets, or potentially a physical imbalance. When we go back to the US, the concept of the intraday market doesn't exist. And the funny thing is, compared to, in contrast to the European markets, that price setting in the American ISO markets is both affected by financial and physical participations. Bids and offers being financial adjust the final price. And this is something that we don't know in Europe. Everything is physical and you cannot participate financially on the day ahead and intraday markets. There might be some people out there that say now, hey, on EX, you have your financial futures on the day ahead. Yes, it's true, but it doesn't affect the physical price. And that is a major difference between the two markets. Jake, next slide, please. So when we also look at some of the other difference between the two markets, it's reflected here in the table. So as just mentioned, the day-ahead market, US, physical and financial sets the price, while in Europe, it's only the physical market, and there is no intraday market as such in the US market. Also, it's important to know that the live market is different. So in the European markets, we call it the imbalance market. It's a physical market. It's a result of having a physical day-ahead or intraday position that's not closed. In the US markets, it's then called the real-time market. You can participate in the real-time market via your financial position on one of the nodes. And the financial position is, of course, a result of a spread that would be a DART spread. They had to real time, and later Stephanie will talk a lot more about this concept. One massive difference as well, the spot trading to get your position in the short-term spot markets on the US markets is happening at the ISO level, while in Europe, the trading does not happen on the TSO level, but it's on the exchange level. And this changes the setup that is required for your activity massively, because you have that additional exchange registration before you can take your physical position and deliver it towards the TSO. Both markets, of course, also support futures trading. It's not so much a topic of today's conversation, but any OTC trading or exchange trading is, of course, possible to have exposure to longer term markets. When we look at the price zones, Jake mentioned already, we have seen it on the chart, about 12,500 nodes, while in the European markets, it's a lot less. So you have around 60 plus price zones, which are then divided over 25 to 30 countries. And some markets have a lot of price zones within the country. A funny note here is that, and pun intended, note that the nodes in the US markets, we have something similar within the European markets, but the pricing is not as such. And for those who are a bit more in depth, flow-based market coupling, for example, it's all about your constraints in between the grid elements of the grid. And basically, that is the nodal concept that we have in the US markets, but in the European markets, the pricing only happens at a country level, while the physical flow constraints that the TSOs are managing are still at a nodal level as well. In total, 7 ISOs in the US markets to get your financial exposure, while in the European markets, you basically have 2 very large exchanges that offer many countries, and additionally 15 separate exchanges where you can get your exposure in a specific country. It's not so much the topic of today, but it's also important to look at the regulation, of course, in the different markets. In the US markets, you're definitely and need to comply with the rules of the FERC, which is at the federal level. You also have the NERC, which is the North American level, also taking into account the Canadian and the Mexican markets. You have your CFTC, the commodity futures regulation and state regulation. Whenever you go to the European markets, it is more on an EU level. We have a lot of legislation, for example, the remit. We also have ACER. You need to be set up accurately ACER, and you have your national regulations based on the countries where you are active. So as a summary, a spot virtual trade in the US market is done at the ISO. It is a trade on a nodal level, and it's a financial or virtual trade. There is the physical trades as well, which will affect the price, but it's not the scope of today. When we look at the European markets, as a conclusion, a spot virtual trade doesn't really exist apart from your EEX day ahead financial future, which does not change the price of the physical market. And a spot physical trade, that's your typical European trade. It's done at an exchange. It's done within a country, a specific pricing of a country, and it will be a physical position, leading potentially to a physical imbalance. That is a short intro there. And now I want to hand the word to Stephanie, who will dive more into detail on the specific ISOs, the specific products that you offer, and how you can get your exposure to long-term and short-term spreads on the notes.
Thank you, Paul. And just a reminder to everybody on the call, you can submit your Q&A questions at any point throughout the webinar, and we do have dedicated time at the end to answer those. Up next, I'll be covering how do these actual products work within these ISO markets. So the three products we'll be talking about today are virtuals, spreads, and FTRs. And what exactly are those? They're swaps. So if any of you are familiar with how financial markets work, OTC swaps or futures, these are essentially behaving the same way. So they are a fixed for floating swap. So what that means is that you have a fixed price set when you were awarded the trade, and then the floating price is set based on the physical market. So on that supply and demand, or think of it as on an index. And so that's moving throughout time, and then at a certain date, it is fixed and set, and then you know your final P&L and final settlement value of the trade. So the three different products that we're going to be talking about today, and we've already started to talk about a bit, are virtual spreads and FTRs. So this is a table meant to give you some understanding of how they're different from one another and how they behave. I will start with virtual, so we'll do one row at a time and kind of cover what a virtual trade is and how it behaves, and then we'll move on from there. So virtual trades are traded in the day ahead market. So much like the physical trades done in the day ahead market, they are submitted as bids and offers into the actual physical day ahead algorithm. And then as that actual algorithm is solved, then you are awarded trades or not awarded trades. So your bids and offers may or may not actually become buys and sells within the day ahead market. But if you are awarded those trades, or they're also called clearances. So if they clear the day ahead market, that means the same thing. So if you're awarded those trades, that means that now you have a virtual position. And the price of that virtual position was set in the day ahead market. So it's again part of that algorithm that the ISO market is solving. And so you know what your position is after the day ahead market, you know what your fixed price is on that particular position. And when you enter this position, it's going to be for 1 day, so the next day, and you can go down to all the way down to 1 hour. So you can bid for 1 out of 24 hours, or you can bid for all 24 hours or anything in between. So you can go down to a large amount of granularity within these markets. Now, a virtual is going to reference one location. So those 12,500 nodes or tradable points that Jake mentioned earlier, that you can choose one of those as your one node that the trade is based off of. And then your floating price, or the price that's going to determine your final settlement, is based on the real-time price for that particular node. So again, the actual trade price when the trade is executed or cleared or awarded in the day ahead market is set in that day ahead market. And then the floating price, the final settlement price of that index price, is set in the real-time market. So the next day. So you have about 24 hours of exposure on those particular trades. Now, a spread, we will often refer to virtuals and mean and also spreads, but it will be implied. So many times in this presentation, if you hear the term virtual, spread is implied, but it is inherently a different type of product. What a spread is a paired virtual buy and a virtual sell. But you don't have to worry about only clearing one half of it. You bid it as a pair into the day ahead market, and you'll clear it as a pair if indeed you clear it. So you'll have a source node and a sink node. Think of a source node as your buy and a sink node as your sell. And those particular paired nodes, you will submit a bid for the price difference between them. And then if you clear it in the day ahead market, your fixed price will be for the price between those two nodes. And then it will settle based on the real-time price, again, between those two nodes. But it can really be thought of as a paired virtual buy and virtual sell. Now, an FTR is like a monthly spread. So instead of trading 1 day, 1 hour at a time, like you can for virtuals, these are traded monthly. So it's for an entire monthly contract, all the way up to 4 years in the future in some ISOs. So you have a much larger duration to these contracts, but they are essentially very similar to the shorter term spreads where you have a source and a sink. So it's a spread between two nodes. Rather than the price being set in a day ahead market, like auction or model, it's set in a FTR auction or model, which doesn't happen every day. It happens usually once a month. So you go into an FTR auction once a month, you put in your bid for your spread or your FTR. And then if you clear it through that auction process and through that model that the ISO is solving for, then you have a position and you know what price it is. But instead of it settling just tomorrow, it's now going to settle on some future month or some future calendar period. So it can be for more than 1 month for an entire year. And you will settle that. But rather than settling it on the real time price, you're settling it on the day ahead price. And that really goes back to when the markets were first created. The intention was and the thought was that most load and generators would want to submit their load and generation into the day ahead market. And these FTRs are really intended to be a hedge between where you might be sourcing your energy, your generation, and sinking your energy, your load. So you can hedge the difference or the congestion between those 2 points with these products. So because the intention was most generators and load providers will want to submit that into the day ahead market, you'd also want to hedge that congestion or price difference in the day ahead market. And so that is a fundamental difference in this type of product versus the more daily or shorter term spread product that is out there. Next slide. So every market has different naming conventions because although they're all regulated or they're majority regulated by the same regulators, they weren't mandated to use the same language. Now, these all behave essentially the same way, but they're called different things. So in MISO, it would be a virtual bid and offer, but in ERCOT, it's a DAM energy bid or a day ahead energy bid. Or in New York, it's a virtual supply and virtual load bid. So you get the idea that there's a lot of different names, but they're the same thing. So what I described in the previous slide, they behave the same way, market by market. But as you're looking at registration materials and you're starting to look at ISOs you might be interested in, you might see varying names. And so this is kind of your source to go back and look and say, okay, convergence bidding in CAISO, that's virtuals. I know what virtuals are. So spreads are also called different names. They are only offered in 2 markets. So in any other market, you'd have to try to clear both the virtual buy and virtual sell and do a synthetic spread. But in ERCOT and PJM, you can trade them as that short-term spread. In ERCOT, they're called point-to-point. In PJM, they're called up to congestion. And then FTRs, which are longer term financial products in the ISOs, they have varying different names as well. So the first market was really PJM, so they call it FTRs. So that's the most common name, but you can see that as other markets have started up, such as CAISO and SPP, they have different naming conventions. And there is a definition at the bottom of what each of those different acronyms stand for, but essentially they are the same thing. Again, they just have different names because the markets gave them different names. Next slide. Perfect. So you're probably wondering, but where do people trade the most? So this is going to answer that question. So this is going to be for virtuals. We will look at spreads separately. So for virtual markets, the largest traded market with the most volume in 2023, this is in megawatt hours, is going to be ERCOT, followed by MISO, then PJM. So for those of you familiar with the markets, you'll know PJM is actually the largest market if you look at load and gen assets, followed by MISO, and then so on. Then they're all much smaller than PJM and MISO. So you're thinking, but why is ERCOT the largest? And why is MISO bigger than PJM? So there's a few reasons for that. The first is that in ERCOT, the uplift fees are much lower than in most of the other markets. And if you are asking yourself, what is an uplift fee? So an uplift fee is the make-whole payment offered to a generator. So if a generator was told by the ISO to run and they ran, but they lost money because the day ahead or real-time market did not pay them enough based on what they were supposed to be paid, and they need to at least break even or make some particular margin. And so what the ISO will do is they will still pay that generator enough so that they're covered, and then they will then distribute that shortfall amongst physical participants and virtual participants in the markets. So ERCOT's fees are generally lower than some other markets are, so it's an attractive place to be. This is also very liquid on the exchange. So each ISO will also have zones and hubs, which are like collections of nodes. And those will be traded on exchanges such as ICE, the Intercontinental Exchange, CBOT, etc. So a number of exchanges, but the more liquid that ISO is, the more attractive it might be to do certain volumes or take certain types of positions, because you can delta hedge on the exchange if, say, something does not go your way on the ISO level. And then MISO is also ahead of PJM. And why would that be? Because PJM is a larger market. Well, they have more tradable points. So you can see that MISO is 2,400 tradable nodes, and PJM, it's closer to 1,500 tradable nodes. And if you're wondering, okay, so that's another reason why the volume's higher, but also MISO's credit costs, the actual cost to participate that you need to post cash collateral in order to secure your trades, is lower than PJM's credit cost is. And so because of that, we've seen this movement of volume to MISO instead of PJM, and also to ERCOT instead of PJM. But you can see here that PJM is still a very attractive place to be. You're still trading nearly, 80 million megawatt hours in the last year across all participants, as well as all these other markets. So CAISO, New York, SPP, New England, they might be smaller markets and they might have less volume, but they all still have significant volume. So there's still attractive places to be. They have different reasons why you might want to participate in each of them. And so this wouldn't be, you shouldn't draw the conclusion that I should only participate in ERCOT and MISO, because there's still very significant trading activity in all of these markets. Next slide. Great. So here we're looking at spread trading. So again, spread trading is only in ERCOT and PJM. And again, the volume is much higher in ERCOT than PJM. So the main reason is that the tradable nodes are much higher in ERCOT than they are in PJM. So PJM only has 50 tradable nodes, ERCOT has 800 tradable nodes. And so that difference is really driving a large portion of the trading volume, because this isn't an individual node you're trading, but remember, it's a source and a sink, so it's two nodes. So you can essentially trade node A as the source to node B as the sink, or node B as the source to node A as the sink, and then all of those different permutations. So approximately, we're going to math, 800 factorial options for the particular node combinations that you can trade for spreads in ERCOT versus 50 factorial approximately in PJM. So there's just a larger number of trading options in ERCOT, which is why we see more volume there. So lastly, I want to look at FTRs. So you'll remember from the last few slides that the top ends of our volume was around a billion total megawatt hours for spreads and 300 million for virtuals. Now you can see we have about 7 billion megawatt hours that were traded in 2023 for FTRs just in PJM. So this is a very large market. There are fewer trades happening in FTRs because you can't trade every day, every hour. You're trading monthly or annual buckets at a time. And so for that reason, you're having larger volumes because it's larger tenor transactions, but it is going to be fewer opportunities to trade than virtuals. But the number of participants trading in both markets is very similar. Some participants trade in both markets, some will trade in just one or the other. But what we can see here is that PJM is the largest for FTRs, followed by MISO, and then ERCOT in this upper right quadrant is the third. And this follows very much the actual size of the markets. And the reason that this is different than virtuals or spreads is because FTRs looking very similar to futures contracts. FTRs were designed to be part of the physical market in order to give greater information for transmission planning and things to the ISO and the participants in the market and for hedging. And there isn't an interest in these being considered exchange traded futures, which they essentially look very similar to that. So there was a compromise made between FERC and the CFTC that said, FERC being the Federal Energy Regulatory Commission that oversees the majority of the ISO volumes and transactions and activities, and the CFTC being the Commodities Futures Trading Commission, which oversees swaps and futures transactions and options and things within the US markets. So there was this agreement between FERC and the CFTC, those two regulating bodies, that said we will not consider these to be under traditional CFTC jurisdiction as long as you cap the volume of FTRs traded based on the physical transmission capacity of the grid in your particular ISO. So that's why we see the volumes matching the size of the markets themselves in FTRs, because there's going to be more volume in PJM because they're the largest and they're going to have the most transmission capacity of any of the ISOs. So that's why we see this different kind of collection and investment level in these ISOs. But again, just because it's capped does not mean there's not a lot of opportunity here. You can see that we have a really significant volume being traded here. And the number of participants, as I said, is the same in both markets, ranging about 500. So you're probably wondering, how do I get started? In fact, I've seen that already pop up in the Q&A. So I'm going to hand this over to Paul to cover that.
Thank you very much, Stephanie. So how to get started? We gotten a lot of info from Stephanie on the different types of trade that you can do. You have your virtuals, you have your spreads, your FTRs, but how to get started? And we need to make one important distinction here between, of course, entities who are already active or registered on the US and those who are not. So we start with the question, of course, for those who are not, to get you some insights on how to start on US trading. And we try to address some of the questions we typically get, and what kind of fundamental setup do you need to become a market participant with the specific ISOs? Where should you be registered? What is a typical timeline? What are your obligations, or how much capital do we need to start trading in the US markets? So let's address some of these questions. Next slide, Jake. We start, of course, with the entity setup. You need your legal entity in the US to trade with these American ISOs, and you need to make some considerations. And this is always a conversation, of course. You have your own considerations, but what kind of setup will you have? Do you go for incorporation? Do you want to have an LLC? Who owns what? And yeah, there's all kinds of considerations, and that's a conversation you should always have internally in how to tackle this in the right way legally to get your right setup. But we can, of course, guide you on these matters. Very important to look at the capitalization requirements. One of the typical questions that we get as a market access service provider is, how much capital do we need? How much collateral in every specific market? And that these questions we get for the European markets, but also for the US markets. So you need to meet your capitalization requirements to make sure you have the minimum capital or collateral available to enter these markets. And in a minute or so, I will tell you a bit more about these requirements. Also, you need to be aware of local representation. You cannot just be in the US and have nobody there that cannot support you, because you need your banking set up. You need to wire large amounts of money. You need to pay your invoices. And just already for opening a banking setup, to have a bank account for your entity in place in the US markets, you might need your local representation. And we can help you with that. Have a local representative that can support you with the opening of the bank account and be your local person on the ground to basically activate your entity over there and start operations on the markets. Things you need to consider on a smaller level, very much important but easily overseen, is you will need different notarized statements towards the ISOs, that who you are, that your financials are in order, that everything that you have provided is complete, accurate, and true. You need stuff like an I number, your federal tax ID, you need a DUNS number, and again, you need to have your bank account in place. So these are a few of the very basic elements that you need in the US to get started with your entity. We can support you on that, and we're going to jump now to the next slide where we'll talk about the ISO specifics. So we start on the left, audit requirements, and these are typically pretty strict. We're dealing, of course, with different ISOs, different approaches, different regulations, but typically somewhere in your journey, typically at the start, you will need audited financials. So the moment you have your entity set up in the US, it might be that you can initiate a market registration without the audited results. Maybe you can get away with an unaudited balance sheet, but somewhere down the line during your process, they do want to see who are you, what are your financials, and they need to be confirmed by an external party, an audit, that you meet the minimum requirements from the local party, the ISO, according to the regulations, that you are a safe and sound party to deal with, also from an ISO perspective, when they consider their own risk. So we have something called the FERC, and the standard for tangible net worth. Well, this is already directly quite a specific, but this is one of the means that parties typically use to show towards the ISOs that they're an appropriate person, that they are a party who is financially capable of delivering the obligations that come with being a market participant. And the magic number here for the minimal capitalization is typically $1 million US. We were not saying that with $1 million you can enter the US, you can be set up at several ISOs, and you can start trading all these markets. Definitely not, but it is a bare minimum to start. You have different ISOs, you have different regulations, but your money needs to be freely available. You need to have that $1 million US, and you need to show it via an audit that you own it, and it cannot be bound up towards other investments or being stuck as a collateral towards another ISO. So you need to really strategically plan your entry in the US markets. You cannot pick one and just see how it goes and go towards the next. You need to decide how much capital do we have, how much do we put into it, and are we able to meet the requirements to enter several ISOs. And this is something where we can help you and guide you. Also, you need to be aware, of course, on the risk, P&L, and VAR considerations. The ISOs, you trade towards the ISOs and you have risk towards them. They are risk towards you, and they want to know, do you know what you are doing? Do you know how to trade? Do you know how to monitor your VAR, monitor your P&L? What are your procedures internally that you use to guarantee towards us that you know what you're doing? You have proper risk management in place, and show this to us. This is required by many ISOs, and also here a bit more on Stephanie in a bit, who will talk about how Yes Energy can support you on such risk, VAR, and P&L requirements, basically, from the ISOs. Then, apart from being a well-capitalized entity, you also still need to place collateral or a bank guarantee, for example, towards the ISOs. It's not just that you need to be worth the 1 million US dollar. No, you also need to place collateral. So it's a double requirement there. The cash collateral that is demanded by the party is not always fixed. It depends, of course, which ISO, how do your financials look like, what are the trading positions that you are going to take, and you might post cash, or you might find a bank that can provide a bank guarantee, where it's always, of course, very specifically about the wording. And please consider that when you go for the route of a bank guarantee, it can be a long route, because it typically takes a lot of time back and forth to align on the fine details of such a guarantee. And again, the small requirements that you might need to consider when entering these markets: again, audited balance sheets, minimum capitalization, consider a bank guarantee if you don't want to post the cash. You need to think about digital certificates like the OATI certificates, which is relevant in many markets. And also don't underestimate the employee training. Many of the ISOs have obligatory training, and you don't just do it in a few hours. You really need to demonstrate your capability of dealing with the platforms, the operations, the financial part, the risk part. So reserve some time for your employees to go through all this training material, because it will be required. Then I would like to give now the word back to Stephanie to talk a bit more on how Yes Energy can support you with your risk measures.
I think you have another slide, Paul.
Apologies, I was too early here. Yes, a little word about us. Again, as we did earlier, we have, of course, the US ISO registrations, and we also want to make the jump again towards the European power markets. I gave a short intro here, summarizing on the left your US registration. What do you need to get up need to get set up on the US markets, on the ISOs? And also similarly, we can support you on the European power and gas markets, where it's typically physical trading. So in case you are looking to a new market, it being European power or gas setup, or a US trading on the US ISOs, trading the virtuals, trading the FTRs, you're very welcome to reach out to us, and we can help you in mapping your entry, supporting you on the actual registration, and making your life easy, that you don't need to run into the roadblocks that we have already seen before. So we can help you out, shortening your time to market and giving you your time and your focus back. Thank you, Stephanie.
Awesome. So thank you for pointing out that there are risk and P&L requirements within the ISOs. And it is one of the things that can really slow down a participant from entering these markets quickly. So what the ISOs require is that if you are trading FTRs, that you have mark-to-market valuation. So these maybe not somewhat, these illiquid products that you're trading at most once a month. Sometimes you'll not trade for longer than that. You do need a way to mark those to market to make sure that you are knowing if you are in the money, out of the money, et cetera, on those, or they've gained value or lost value since you purchased them. Another thing that is also required is a probabilistic-based risk assessment. So what that really means is a value at risk, or a VAR. So that is required for these financial products as well in order to participate in the markets. And this is something you have to certify annually, and that the ISO can audit you on as well. So it is important to have it in place before you start participating in the market. So at Yes Energy, we do have something called position management. It is a solution which is intended to meet the requirements for you, so you can more quickly and easily enter these markets. We do automated deal capture of all these different trades we've been talking about today. We do the realized P&L, which you can see here on the right. So this is showing kind of the daily realized P&L breakdown by ISO, by product, by trader name, etc. We also do the mark to market of your FTRs and risk metrics. So we have a 95% confidence interval VAR, 99%, and stress testing, as well as a custom risk engine for FTRs that you can kind of set up your own view on the world. So again, this can really help you enter these markets quickly, make sure that you're meeting those requirements so that you can kind of proceed into your US expansion, either into your first ISO, or whether it's into a subsequent ISO, and feel confident that you are meeting the requirements and ready to go. So with that, I'm going to hand it over to Jake, where he's going to show you a little bit about some of our tools in order to identify virtual and spread trade opportunities, and how to submit them directly to the market.
Thanks, Stephanie. Thanks everybody for participating in the presentation today. We thought we'd just go through quickly and show you what kind of a virtual trade looks like. So whether I use visual analytics tools or just the pure data behind all of the markets, I can come in here and quickly survey the market. Here I'm looking at a single day in the past. Again, I'm looking at all of those nodal level prices that we were talking about earlier. And in this case, I'm actually scanning the market for where were those largest dark spreads. So that delta between the fixed for floating, the day ahead price versus the real time, and what is that actual return on that virtual trade. I can see some other things on the map here, some proprietary information around line flow and power plant output for the current time interval that I'm looking at here. But one of the other things I can do is come in and decide, I want to look at a trading strategy around this particular node. I can quickly jump into another tool, and you kind of already saw this earlier, called the nodal profile tool. And in this case, I can get a time series view of what were the prices, both day ahead and real time. Again, that's that green and yellow lines we see there, with the dart spread or the return there in the background. Again, this is a node in ERCOT. Maybe I want to come in here and start looking for different trends in those returns. So instead of looking at it in a date time format, maybe I turn it around and I look at hour of the day. And in this case, what I can see is that basically in the off-peak hours, we do see a little bit of a trend in this being a selling opportunity. Again, I'm going through these really quick just to give you a little bit of an idea here. With those off-peak hours, maybe I want to come in and enter a trade here. So I can put a 5 megawatt trade on for the early morning hours. And maybe I'm willing to sell that at, let's say, $40. I can come in and enter that here. I can do the same thing for the other end of the off-peak time, so the evening hours. I can add that trade to a queue, and I can add that to a portfolio. One of the things that both Paul and Stephanie were mentioning is beyond just registering with the ISO after I've done my market training, eventually at the end of the day, I get my credentials to trade. One of the really nice things here in the platform is that I can upload those certificates into the platform and be connected to the actual ISO. And that can be for all 7 ISOs. And one of the nice things I can do here is once I have my trade sheet built, I can look at my trade sheet on this view where I'm looking at my different individual bids and offers for each hour of the day at all the different points, my buys and my sells. I can actually come in and quickly, again, kind of going back to some of those differences in market rules. When I hit that validate trade button, it actually went through for the market that I'm in and said, all of these are valid trades. They comply with market rules. I'm not performing anything like a wash trade. I'm not busting any limits as far as day ahead bid and offer caps. And so I know those are all valid trades now. And then the next thing is really sending this off to the market. So one of the other things with that certificate uploaded here is that I can submit this portfolio by simply confirming with a typing in yes here. And now my trades have gone off to the ISO. Obviously, it's a test system. Yes Energy does not have any active trading certificates. But the other really cool thing too that I can do is withdraw all these trades. And while that sounds simple, all the different markets have different ways of doing that. Some of them make you submit zeros back into that portfolio to cancel out all those trades. Some you can simply withdraw. Again, all that's being done in the background here, depending on which market we're looking at. And then, of course, after I enter this set of trades, I'll be able to see what my position is when the day ahead market clears and then track those results in real time. And so that was just a really quick run through. Obviously, we could set up some time and go through more of that. But with that, I believe, Stephanie, we're at the end of the presentation.
Awesome. So we do have some time for Q&A. So we'll take as many questions as we can while still finishing on time. And then if there's any questions that you still have after the Q&A, we definitely will give you the opportunity and the information on how to send those to us to ask those as a follow-up to the webinar. So maybe I will start with some questions here that I see. So one was around, let me see if I can find it. My goodness, it disappeared maybe. Never mind. So maybe Jake, can you handle this one? I'm going to publish it. If KISO is so much smaller, why does it have so many more tradable nodes?
A lot of it just has to do with the way the ISO structures those nodal settlement prices. Again, I say settlement prices, that's a specific term. Different markets call it different things. For instance, there are different types of nodes in an ISO, and in the model, a lot of ISOs have what are called bus nodes, which are even more granular than the 12,500 nodes that we saw on the screen, but they then roll up into what's called settlement nodes, and those settlement nodes are the ones you can trade. And so each market is different. KISO has many more nodes that are tradable. They almost look a little bit like bus nodes in some of the other ISOs, but that's really kind of just the way that KISO chose to structure that. PJM does it a little bit differently. They have what are called FWAD nodes, so they're fixed weighted average nodes. A bunch of smaller nodes go into one settlement node that you can trade. Same thing with ERCOT. So it's really a market structure of what they chose to have as settlement locations where I could actually make those trades.
Okay, great. Someone had the same question for ERCOT. I'm going to assume it's the same response, or do you have anything additional to add there?
Yep. Same thing with ERCOT. I forget the number. It's in the thousands of bus nodes versus the 800-ish that are tradable nodes, but the same type of market structure. It kind of just depends on how the ISO was set up.
Yeah, and there is another question that came in around the point of virtual position. So I'm publishing that one. So kind of what is the value of virtual positions in the market? So that actually goes a little bit into, I think, answering your previous question there too, Jake. So virtual positions are intended to provide more price information to the ISOs themselves so they can better solve the day ahead market. So imagine if you had the only inputs coming into the model from participants being just load serving entities and generators. You wouldn't have the same amount of information coming in as you do from virtual participants that are doing a significant amount of legwork to figure out what the right pricing is for that particular node. So they're adding just more price certainty. And there has been some analysis done. If you look at the MISO State of the Market report, it is something that you can find multiple years of. It's published annually on their website. They do go into some information about how much virtuals have helped to improve solving the day ahead market and have helped to improve price formation, et cetera, across the ISO. So you can definitely dig into that a little bit more. But that is also some of the reason behind the node counts that you see. PJM used to have more tradable nodes for their spread product, and it was decreased because they did an analysis and figured out that some of the nodes that were being traded, i.e. the ones not traded anymore, were not helping with price formation and traditionally did not. So they actually cut down the number of nodes available to trade for that reason. So in some cases, it's somewhat kind of market driven / political is the reason that these have changed a bit, but that is the reason that PJM specifically was decreased.
And one funny thing from Stephanie's slide earlier, where all the markets have different names, if you kind of want to know about the idea of a virtual, in KISO, it's called convergence bidding, which the idea being that the more participants that we have in the market bidding and offering on the nodes, we should be converging that day ahead real-time spread. So the theory is that the more participants we have, the smaller that inefficiency between the day ahead and real time will be. So it's right there in the name conveniently for the ERCOT product or the KISO product.
Awesome. So Jake, go ahead, Paul.
Yeah, so there's one other question that we see, and I will publish it now, and it is on the FTRs. There's some uncertainty there. Just to summarize that everyone understands that the difference between an FTR and a virtual trade is that an FTR typically is a product that is at least monthly. So you get your exposure for the full month, while a virtual is a much more of a spot trade where you can pick a specific hour on the day ahead. Because a monthly product has more volume in it, you also need higher collateral. It will require more of your money, so the entry barrier for the FTRs is also higher. And it's important to emphasize again the difference in the settlement. So where a virtual trade is bought in the day at auction and settles against the real-time market, your monthly FTR is bought in an auction, typically once a month. So you buy it at the auction settlement price and it settles against the day ahead price. And there we can also make the jump towards the European power markets, where the American FTR is traded or auctioned at the ISO. In the European market, we see something similar, the financial transmission rights or the physical transmission rights, which are auctioned, for example, at the JAO platform.
Thank you, Paul. So there's a question here I think you can answer, Paul. Is there any prospect of European energy markets transitioning to a more granular structure like this?
As far as I'm aware, there is no plans to heavily restructure the European markets. There's always incremental work going on. So an example there is the markets from nearly a decade ago being very explicit. So all the cross-border capacity between the markets being explicit, flow decided by traders, moving towards a coupled system where the Euphemia algorithm couples things. Later integrating flow-based market coupling, which optimizes the cross-border capacity constraints, and expanding that also to new markets, flow-based market coupling core, and soon the Nordics will also be included. So there's always improvements going on, but typically it's about making the market more efficient and not drastically changing the structure. So we don't expect that any setup like the nodal system like in the US would be active in the European markets. However, it is also still a part of the European markets, given the flow-based market coupling and all the complexities behind that. So it's used in the calculation, but there is no plans to make the granularity finding on a trading level.
So thank you. So similar to that, Jake, there's a question that came in. If you can elaborate on the expansion of financial trading in the West that you hinted at?
Yeah, so that kind of blank spot we saw out there in the West between CAISO and kind of the border of SPP, both the CAISO market and the SPP market have market models that they're moving into those Western areas that still effectively operate in a real-time market only. SPP has their model. They have a couple of different versions of it. One is just a pure expansion of the ISO, so not really a different market, just going over the DC ties into the West and running the same market model for a few entities out there. There's also a subset of that, the Markets Plus program, that's going to move a few of those kind of regional areas out in the West to a more centralized dispatch model. And then CAISO also has what's called the EDAM, or the expanded day ahead market, for some of the areas that they already do real-time dispatch for out there. And most of the timelines around those are kind of the 2026 and beyond time frame, but some of those will have options for virtual trading.
So thank you for that, Jake. Another question was whether there's been much of a presence of algorithms in trading these markets. So I can tell you that for sure within our submission product that Jake demoed, that we do have API endpoints that are specifically meant to enable that activity. So we have seen that filtering through those products and coming into the markets. Do you want to expand on that, Jake?
Yep, a lot of new entrants are tackling the virtual trading market through algorithmic trading. We do have legacy participants and traders that are also moving to that model. But I would say there's still a pretty decent mix of algorithmic trading and fundamental trading. Again, a lot of these markets, if you kind of are in them, watching them, seeing the trends long enough, we still have a lot of people that trade off the screen. So kind of the demo that I just gave, but definitely a large interest and uptick around some of just the data pipelines to ingest data, model that data, create a bid strategy and portfolio, and submit those every day. So a lot of high volume on the data side as well.
Great, thank you. So I do think we are out of time, and apologies if we did not get to your question. We will follow up with you if you had a specific question that was not answered here, if you typed it in a way that's not anonymous. If you did type it in anonymously and you do so want the answer to the question, if you want to go to the next slide for me, Jake. You can send those questions in to either Yes Energy or Time2Market using these various emails here. So again, if you put in a question anonymously, we would not know that that was you. So if it's something you want to follow up on specifically, if it's not in our standard reply and response, feel free to send those questions in directly here. And we definitely look forward to hearing more from you. So as a reminder, this recording will be sent out to attendees, so you will be able to rewatch this or send this to other people in your organization that might be interested. Otherwise, thank you so much for your time today, and I hope you have a good rest of your day.